שלום לכולם, תודה שהצטרפתם, אנחנו מתחילים. רועי? אז שוב, שלום, תודה רבה שהצטרפתם אלינו. אנחנו מתחילים בסדרת הוובינרים שלנו על פילר 2. אני אציין שהסשן הזה יהיה בחלקו בעברית ובחלקו באנגלית. יהיה לנו סשן של Q&A בסוף הוובינר, כך שכל שאלה שעולה לכם במהלך הוובינר אתם מוזמנים לכתוב ב-Q&A בוקס למטה, ואנחנו נתייחס לזה בהמשך. ועכשיו אני אשמח להציג את ווילי אליזרוב, שותף מחירי העברה אצלנו בדלויט. ווילי, הבמה שלך.
תודה נוי, בוקר טוב לכולם. ברוכים הבאים לסדרת הוובינרים החדשה שלנו בשם פילר 2 From Policy to Practice. כמו שהשם מרמז, אכן הכוונה היא בעיקר להגיע לפרקטיס, להיבטים המעשיים יותר. אני חושב שללא ספק, ובטח כולנו נסכים, שכל נושא הפילר, גם פילר 1, גם פילר 2, ובעיקר אנחנו מתמקדים בפילר 2 כי הוא הרבה יותר רלוונטי לחברות הישראליות, הם מעין מהלך ממש חסר תקדים בקנה מידה בינלאומי. אנחנו כבר רואים ש139, שוב מספר חסר תקדים, 139 מדינות כבר הצהירו על הכוונה ליישם את היסודות. אתם תראו בסוף גם את הרשימה של המדינות שכ-40 מדינות שחלקן יחלו ביישום כבר ב-1 בינואר 2024. אז כמובן שזה באמת מהלך מאוד משמעותי וחשוב שכולנו נהיה מוכנים. כמו שנוי ציינה, אנחנו עשינו הצגה היום יחסית קצרה, כ-30 דקות, עשינו את זה בכוונה כדי לא להעמיס עליכם במידע התיאורטי, כדי גם להשאיר לכם מספיק זמן לשאלות. מה שחשוב לנו גם שבמסגרת השאלות אתם באמת מוזמנים לציין כל נושא שתרצו שנתמקד בו בוובינרים הבאים בסדרה. נשמח להרחיב ובאמת להתמקד באותם נושאים שמעניינים אתכם יותר. יחד איתי היום יציגו רועי פרייליך. רועי הוא מנהל בכיר אצלנו בחטיבת המיסים. רועי הוא מרצה בינלאומי, מרצה בקבוצה בינלאומית של דלויט, ללא ספק מומחה ברמה הגבוהה ביותר. אני גם מוכן להסתכן ולומר כאן שאין בארץ מומחה גדול מרועי. יחד עם רועי יציג גם סגי דרזון. סגי גם הוא מנהל בכיר אצלנו בחטיבת המיסים. סגי גם עבר הכשרה מיוחדת בלונדון, ושניהם יחד מוכנים או מזומנים, הם מכירים את המטריה, הם מכירים את כל הכלים המעשיים, הפרקטיים שזמינים לנו לסייע לכם להתמודד עם האתגר הזה, והאתגר הוא אתגר בהחלט לא מבוטל. אז כמו שהבטחתי להיות מעשי, אז יקצר פה בדבריי. רועי, the floor is yours.
Thank you, Willie. So today we're going to look at the rules, the Pillar 2 rules, but in a high-level overview to really give you a flavor and an understanding of what this is all about. Principally, the Pillar 2 rules came from the OECD recognizing that the digital economy allowed businesses to exploit the current international tax system that was historically based on a bricks and mortar basis. And to this extent, Pillar 2 aims to ensure a level playing field so that businesses are paying what is deemed the correct tax in each country. And so this came and therefore resulted in a very unique practice whereby we are seeing 139 plus countries applying the same rules in each way. Now, under these rules, what's going to be is that each group will need to pay an effective minimum tax, and that's important to bear in mind. We're not talking here about statutory taxes or legal taxes required by a country, but rather an effective tax, which is calculated specifically on a case-by-case basis. And that will be adopted globally. So what this will result in is a very new and complex compliance process with separate calculations. It's not your dohatama, it's not your financial statements, your doch katspi, it's something in addition. So those things that you've done up to now are all relevant. You will still need to do them. The complexity and the consideration you need to give is to what is the additional work I have to do, the additional new Pillar 2 specific tax return that I need to now give in addition to my regular tax return that I've done up to now. And the amount of data that is therefore required, because this is done on a global level, is significantly more than we've ever seen previously. And as a result, businesses are seeing not only a need for compliance and understanding, but also an ability to understand their own internal data systems to make sure that they are ready to pull up the relevant data to calculate these taxes and ultimately to file their return and not have any issues down the line. So today we're going to look at how the calculation works, what the principles are, and to understand what businesses need to start thinking about from today. So an understanding of Pillar 2 is that it comes with several steps. And first and foremost, the group needs to check if they are within the rules in and of itself. And this is a very specific test. This is something that needs to be done on a year-by-year basis. And we will have a look at exactly what the tests are to see if the group is within the scope. Now, once it's been determined that we're in the scope, we need to calculate this magical effective tax rate number. Now, this is a different number to what we've ever seen before. This is not just taking your tax paid from your dohatama and dividing it by the profit in your doch kaspi. It's separate. It's new. You have to make a calculation of that profit. You then have to make another calculation for what the taxes are for Pillar 2. And only then do we have your effective tax rate. But what's important to bear in mind is this is done on a country by country basis. It's not done as a global group level. It's not saying if I pay 20% in one country and 2% in another country at average. Every country is independent. So each calculation needs to be done independently for every country. The benefit of this, though, is that it's on an average of a country, which means if you have 2 or more companies or entities within a particular country, you will average out. So if we take, for example, in Israel, and you have chokidud in Israel, and you have chokidud of 12% in one company, but another company paying full tax at 23%, they average out, and you still may have an effective tax rate above 15%. But what the thing to note is that you have to do the calculation to understand this. Once we've done that calculation, we then can understand if we have any additional tax to pay. But once we've even understood that, we need to then determine who is even going to pay the tax. And there are several methodologies for understanding that. So it's a long process. And the point, as we said, it's complexity, it's challenging, it's new. And even the tax authorities around the world are struggling with it. So we're here to help you, to get you ready. So I promised to explain what the scope is. The scope works on a group level, and it's important to bear in mind that when we talk about Pillar 2, we're primarily talking about consolidated financial statements. So companies need to be checking where are they preparing those consolidated financial statements, and if they are preparing those consolidated financial statements. Because what you could end up in is a position whereby you have to create a specific set of financial statements just for Pillar 2. For example, if you are in a country that does not require consolidation, then you would potentially need to include that and redraft something new. Again, this is why preparation is key. So the group is based on consolidation on a line-by-line basis, and we're looking at multinational groups. And a multinational group for this purpose is not what we regularly consider, but it includes any sort of presence in another jurisdiction. So any branch or permanent establishment will still be considered a separate entity. That's the first test. Are you resident? Are you present in more than one country? The second test is about revenue. So we look at the pre-consolidated annual revenue of the group, so pre-adjusted consolidated revenues of the group, and are they above 750 million euro in at least 2 of the last 4 years before now? Let me give you an example. In 2024, we're looking at the rules in 2024. We need to see, are we in scope? So we'd say, do we have more than 750 million euro in any of the years of 2020, 2021, 2022, or 2023? If we do, then we are in scope. And if we don't, then we can fall outside of the rules. But let's bring this into an example to make it more visual. In this example here, we've got a case of an ultimate parent entity. It owns 2 subsidiaries fully controlled of A1 Co and A2 Co in country A. A1 Co owns 60% of the shareholding in B Co, which it will consolidate, and A2 Co owns 10% of C Company. Now, because it's only 10%, it is not consolidated on a line-by-line basis, but rather under accounting principles, it will be just recognized as an investment under the equity method. So for Pillar 2 purposes, our group, assuming we breach and we are above the 750 million euros, is going to be the UPE, A1, A2, and B. That's our group. Another example to show you is, what if I just have a simple example of an Israeli company or an ultimate parent entity with a branch in another country? In this case, even though the branch does not have a separate legal presence, from a Pillar 2 perspective, it is considered another entity, and therefore we do have a multinational group, and therefore that test is met. So we've got our group, we're in the scope, we've understood that. We now need to calculate step 2, which is that effective tax rate. And as I said, this is done on a country-by-country basis, and it has got a level of complexity. So when we're looking at effective tax rate, we say the adjusted covered tax, so the specific taxes for Pillar 2, as a proportion of the profits or the relevant profits of all of the entities in that country for the group. So what does this mean from let's look at the profit, the denominator, the lower number first. The starting point to calculate the profits of the entities of the group in that country is looking at the financial statements used for consolidation prior to that adjustment. So if we have it a basic level of when we're doing our consolidation, we have all of our entities. We then adjust for any intercompanies and other things, and then we have our final consolidated accounts. We're looking at that pre-adjusted number. Now, in this case here, what we have to bear in mind is, if you have, for example, a permanent establishment, they may not have been included in these financial statements, so you will need to start thinking, how do we get that data? Once we've got that number, we move to part 2, which is adjusting for Pillar 2. And there are a number of adjustments that need to be made where the OECD is saying, okay, we're looking across all the 139 countries and trying to create a level playing field. So they've made some adjustments to account for this. For example, when you have dividends, many countries have a participation exemption. So the OECD have said that where you have a dividend being paid, if you meet certain rules, that dividend is going to be excluded and you don't include it in the profitability of that company. Similarly, if there's things like gains or losses from a reorganization, they can also be excluded from the calculation. So this can either reduce or potentially increase the profitability of a company in that country. In addition to this, there are a number of elections that can be made. And we will run another session in the future to go through a lot more detail about these elections and these adjustments as well. In terms of the taxes, it's important to note that not all taxes were created equal for the principles of Pillar 2. So we're looking principally at those taxes that are related to income. So your corporate taxes, your withholding taxes, but things like payroll or VAT would not be included here. So you would take them out of your calculation. So we start off with our taxes paid, or our tax line from our financial statements, but we remove from it anything that is non-qualifying. So as I say, payroll, VAT, potentially other types of taxes as well. And then again, we need to make adjustments. And the principle of these adjustments is to create that level playing field. So it's looking at what income, what expenses relate to the Pillar 2 rules. So where we've made adjustments in the denominator, in the tax base, we would therefore need to similarly adjust the top number as well. The addition to this is that we're looking at taxes paid. So if, for example, you have uncertain tax positions, so for anyone working in the US, you're looking at your FIN 48 pretty much, this would not be included, and you would adjust your Pillar 2 provision to take out that number. What's more than this is deferred tax. Now, deferred tax is the challenge of everyone, whether they be in business or whether they be accountants or even tax professionals. It always is a complexity, but it's ever more important because within the Pillar 2 rules, you have to consider how deferred tax is going to be affected because it is included within that tax number. So you're taking it, you're potentially recasting it to 15% and also having to make adjustments for any of the other points that were within the Pillar 2 rules. So the point here is complexity after complexity. We're just trying to get to that number. There are a lot of specific rules to know, and therefore understanding your data, understanding the rules is really, really important. Now, once we've calculated that effective tax, we therefore need to see, do we actually have any cash tax to pay? So we can say that, we've got our effective tax rate, it's less than the 15%. Well, what's the cash tax impact? What is this going to impact my company like? So we look at this with the following formula, and the basic principle looks worse than it is, but it's saying the difference between your ETR for the country from 15%. Is it lower? And then you multiply that by your Pillar 2 tax profit, as it were. So the Pillar 2 tax profit you can see in green. This starts with your tax base. So this was the denominator that we just calculated for our effective tax rate, all those adjustments that we made. And we reduce it, though. The OECD have given us a principle whereby if you have substance, if you have presence, so things like factories or buildings or payroll and people, you can get a percentage of that as a reduction from your tax base. So this gives you an incentive to increase presence because it can reduce the impact, but ultimately the calculation needs to be done on a case-by-case basis. So we've worked out that there's tax to pay. We've worked out our ETR. We understand we're lower than 15%. We've then calculated how much tax we need to pay. The question is, who pays it? Up to now, we all know you have tax in Israel, you calculate it for Israel, you pay it in Israel. That's simple. Pillar 2 is not so simple. Pillar 2 works in one of three ways. The first, this is the principal way, is countries can elect to legislate for what they've called a qualified domestic minimum top-up tax, or QDMTT. Now, a QDMTT is basically the OECD's allowing countries to say, okay, you've got a low tax rate for this company in your country, but rather than allowing taxes to be paid somewhere else, we're going to let you keep them. And you pay the tax in the country. So if you have a 12% effective tax rate in the country, you can pay the additional 3% of tax that's calculated through this QDMTT. If you don't have a QDMTT in the country, if they didn't legislate for it, they didn't want to do this, then the default rule is what's called the Income Inclusion Rule, or IIR. And effectively, this allocates the top-up tax on a top-down basis. So you're looking at the ultimate parent entity of the group, the topmost company of the group, and you pay it down. So if the topmost company isn't in the rules, you'd pay it lower down. But ultimately, it's paid outside of the country in which the tax arises, which is why the QDMTT came in. There is a backup rule to all of this. If there's no income inclusion rule, if there's no QDMTT, then the other way that countries can force to be the tax to be paid, or the top-up taxes to be paid, is through the undertax payment rule or undertax profit rule. Effectively, this is a backstop where we allocate the additional top-up tax between all the companies in the group based on a percentage of payroll and tangible fixed assets. So you can see the still carried on importance of substance, of physical presence, as having a role in these rules. So let's make this a little bit clearer, because I appreciate we've given a lot of words, but let's put it into numbers and give an example. Here I have a simple example of a parent company with two subsidiaries, A1Co and A2Co. A1 has a full subsidiary, Bco, in another country, while A2Co has an investment in Cco in another jurisdiction. We said at the beginning, if you can recall, this group is limited, Cco is outside. So the question is, what's the tax? Calculated that Bco, we've done all of those calculations, and Bco has got an additional tax to pay of 100. Who pays it? So first and foremost, we said, if there's a QDMTT, a qualified domestic minimum top-up tax in Bco, through the rules. If there's an IAR, if UPE, if the ultimate parent entity is within the rules, then they would pay the top-up tax first. It would be applicable there. If the ultimate parent entity is in a country that does not apply the rules, then the tax is then paid down the chain. So we'd look at A1Co. Let's take another example. What about in this case here? This is an easy group. You have an ultimate parent entity with a subsidiary, fully owned subsidiary. That subsidiary is a 75% holder of Bco, and Bco holds 100% of Cco. In this case here, even if all of the countries apply the IIR and the UTPR, all of the rules apply, everything applies, normally you would expect that the tax is being paid, as we said, at the UP, the topmost level. But in this case, the actual tax would be paid lower down at B. Now, going into why that's the case is outside of the scope of this conversation. We don't have the time today, but we will certainly cover it in future. But the principle to note is the complexity, that even within understanding where taxes are paid and how taxes are paid and how they're calculated, still understanding of where it's going to be paid can still be a little bit confusing. And therefore, it's really important to understand the group, understand the structure, and understand how the taxes are paid. So I've spoken a lot about complexity. I've spoken a lot about how it's calculated. But I'd like to hand over to Sagi, who can tell us how it can be simplified.
Thank you, רועי. אז שלום שוב לכולם. רועי הציג בפנינו מבט מלמעלה של הכללים, לרבות הקבוצות שנכנסות בגדר הסקופ, והחישובים שנעשים פר מדינה. חשוב להבין שהחישובים האלה מורכבים, דורשים איסוף מידע רב, ועל המערכות הכספיות שלכם להיות מוכנות לאיסוף המידע הזה. אבל כמו שרועי אמר, ה-OECD בחלק מהמקרים גם בא להקל, ולמעשה הכללים כוללים למשך לתקופת הביניים של 3 שנים, החל מ-24, safe harbors, למעשה שמבוססים על דוח ה-CBC של הקבוצה, והם, המטרה שלהם העיקרית היא להקל על החישובים המורכבים ועל כל איסוף המידע. חשוב להבין פה שלא כל דוח CBC הוא qualifies לצורך ה-safe harbors, זאת אומרת, צריך לבדוק האם הדוח באמת תוכן בהתאם לדרישות של הכללים, ורק אז לעשות בו שימוש, וה-safe harbors האלה הם לבחירה, זאת אומרת, מרגע שבוחרים אי אפשר לשנות, ולכן לבחירה הזאת יש משמעות. אני גם עוד רוצה לציין שרק אתמול בערב ה-OECD פרסם עוד 2 safe harbors, עוד לא ניכנס להם עכשיו, אבל בהחלט ייתכן שבסשן הבא אנחנו ניכנס יותר לפרטים. זאת אומרת, אתם רואים, ה-OECD מספק כללים מאוד מורכבים לחישוב ובא להקל, אבל אז גם באותה נשימה הוא מסבך את העניינים עוד פעם. סלייד, פליז. אוקיי, אז יש גם הרי מקרים מיוחדים, הכללים מתייחסים גם למקרים מיוחדים של או ישויות או מקרים מסוימים. ככה למשל יש כללים ייחודיים לחברות ביטוח ולבנקים, יש כללים ייחודיים לישויות השקעה, יש ישויות שהן פטורות בכלל מהחישוב של הכללים האלה. לכל אחד מהישויות והמצבים המיוחדים האלה יש הגדרה בכללים, ההגדרות הן מאוד ספציפיות, ולפעמים אפשר ליפול ואפשר שלא ליפול. אני רוצה גם להתייחס לנושא של ה-M&A, שזה גם נושא שצריך לשקול. הכללים מתייחסים מה קורה במצב שבו אנחנו קבוצה שלא במסגרת הכללים, ועכשיו רוכשים חברה או קבוצה גדולה יותר, ועכשיו כל הקבוצה כולה נכנסת לתחולת הכללים החל מאמצע השנה. גם בנוסף צריך לשקול מהכיוון של החברות המטרה. אם חברת מטרה עכשיו נרכשת ומצטרפת לקבוצה שהיא נכנסת בגדר הכללים, גם אז היא צריכה להתחיל לשקול את כל הנושא של האימפלמנטציה של פילר 2. אז אנחנו רואים איך ה-OECD בא להקל ומפרסם safe harbors ובאותה נשימה מסבך את זה גם. אלה רשימה של כל המדינות שחברות ב-Inclusive Framework, ולפניכם יעלה עכשיו הלוז של היישום במדינות השונות. אנחנו יכולים לראות שהאיחוד האירופי כבר אימץ את החקיקה, והיישום שלה מתחיל בינואר 24, עוד 5.5 חודשים. כך גם שוויץ והממלכה המאוחדת ב-UK ומדינות נוספות. אם תשימו לב, תראו שארצות הברית לא נמצאת כאן. ארצות הברית, בגלל המצב הפוליטי שם, עדיין הם יושבים על הגדר. אנחנו צופים שאימוץ מסוים כן יתרחש, אנחנו לא יודעים להגיד מתי ובאיזה אופן. זה לגבי ארצות הברית. לגבי ישראל, שגם היא לא ברשימה, אז אנחנו בקשר מאוד קרוב עם הצוות המקצועי ברשות המיסים שמוביל את זה, אם זה מיכאל אסולין, מנהל המחלקה המקצועית, והדר, שמובילה את הנושא של הפילר 2 ברשות. כרגע רשות המיסים בוחנת, פרסמה את ההתייחסות שלה בכתבה בגלובס, הם בוחנים את היישום ואת ההשלכות של זה, ואנחנו עוד עתידים לראות פרסומים נוספים מהרשות בנוגע לעניין הזה. בנשימה זאת אני אעביר את הבמה חזרה לווילי. לא, סליחה, טעיתי. איך דלויט יכולה לעזור? אז הכלים שלנו נעים לאורך כל הספקטרום של פילר 2, אם זה מהערכת הפוליסי הרצויה על ידי הקבוצה, ועד לציות עצמו והגשת הדוח שעוד עתיד להתפרסם מהתצורה שלו, ולשם כך דלויט ברמה הגלובלית פיתחה מספר כלים שאנחנו נדון עליהם בהרחבה בוובינר הבא באוגוסט. כלי אחד הוא הכלי ה-Data Diagnostic Tool, הוא למעשה כלי שמאפשר לנו ולקבוצה להעריך האם יש ביכולתה לאסוף את כל המידע הדרוש להרכבת הדוח, אותו דוח גלוב. זה כלי אחד. כלי שני הוא הכלי של המידול, למעשה איזה מודל הוא הכי מיטבי לחברה, לקבוצה, עם בחירות מסוימות שאפשר ליישם בקשר עם יישום הכללים, או ניצול ה-safe harbors. וכלי נוסף שיש הוא הכלי של הציות עצמו, למעשה הולכים יד ביד איתכם, מהשלב של איסוף החומר ובדיקה אם יש לנו את היכולת ואנחנו ערוכים לאיסוף המידע, ועד לשלב הסופי שכבר להגשת הדוח ועמידה בכללים. אז עכשיו, בלי טעות, אני מעביר את הבמה חזרה אליך, אורילי. תודה.
תודה, סגי, מקבל בשמחה. אז יש לכם את השעון הנפלא הזה, שבאמת מראה כמה זמן נשאר לכם ליהנות מהחיים היפים עד 1 בינואר 2024. זה כמו החצי כוס המלאה מול חצי כוס הריקה אולי, חלק יגידו יש לי מספיק זמן גם להתכונן, זה הכל כמובן בעיני המתבונן. בכל אופן, בכל הקשור להכנה נאותה, אז אנחנו בדלויט תכננו פה צוות, שימו לב שהוא גם צוות רב-דיסציפלינרי, כי זה לא רק מיסים, זה גם חשבונאות, יש פה הרבה היבטים טכנולוגיים, ואגב, הוובינר הבא מתוכנן ל9 באוגוסט, כבר עוד מעט, הוא יתמקד בהיבטים הטכנולוגיים והפתרונות הקיימים, שאמר שיש לכם פה צוות מגוון, אתם מוזמנים לפנות אלינו בכל שאלה, נשמח כמובן להתייחס, אז אני חושב שאנחנו בזה, תודה רועי, תודה סגי, אז בואו נתחיל לענות על השאלות, אתם מוזמנים תוך כדי גם לשאול עוד שאלות. I think I will switch to English because I see that some of our participants are not Hebrew speakers, so let's do the questions in English. So I see that a couple of questions are quite similar. So people are asking some specifically about Israel. Some questions are more general, asking what happens if the country of the ultimate parent entity, the holding company, okay, does not implement the rules, such as the case with Israel and many other countries, or maybe you're located in some kind of tax haven country that did not announce and may not announce eventually the implementation of the rules, okay, should I really care or that is not going to impact me? Rui, would you like to answer that?
Sure, it's a really good question. The basic principle here is that the rules will apply regardless. And when we look at these rules, what we have to think about all of those steps. So when we look at the scope, we're looking at consolidation. Are you consolidated for accounting purposes? Should you be consolidated for accounting purposes? In which case you will fall within the scope regardless of whether the ultimate parent company has entered the rules or not. You're looking at it from that perspective. And then once you get to the point of calculating the tax, well, the whole point of these rules is to say, well, we're going to look at, are you paying the right tax in each country? So you can have a situation whereby if you have, let's say, a UK company or a European-based company based in Europe, that you are then going to have to calculate the tax, the taxes for all of the countries, but they will be paid in Europe. So the whole purpose here, the whole point here is to realize that from the 1st of January 2024, with so many countries, with the EU intending to have all of its member states legislated for, the UK having legislation, Korea, Japan, Switzerland, all these countries having legislation in place ready to start in 2024, even if Israel is at the top of the group or a tax haven is at the top of the group, the taxes can still be picked up in those other countries. This also leads on to why the US is likely to fall within the rules, because even their own Treasury report that came out a couple of weeks ago stated that within the next 10 years, if they did no work whatsoever, they did not implement Pillar 2 at all, they would stand to lose $122 billion of tax revenues. So a long answer, but simplicity in simple terms, yes, it still applies.
Great, Rui, thank you for that. Another question also, I think it's kind of general. The question here is specific to Israel, but I think we can also, take a wider look at that. So question is about the encouragement law in Israel, and we can take it as a more general question with respect to any, encouragement law elsewhere, IP regime boxes, whatever, like regimes are available anywhere in the world. So the question is is there really the implementation of Pillar 2, is it going to be end of story of all the, encouragement laws such as, Hokkedut in Israel, such as IP boxes in some countries? So I think, definitely that I will take that, with your permission, Rui. So I think, I think that they're like, definitely they're going to be more complicated to implement the encouragement law in Israel or any other country. But at the same time, I think we do have a couple of good news to share. So one would be, first of all, you need to remember that the tax burden, the effective tax rate, is looked at the country level. And I think we mentioned that during the presentation. Even if you have like one entity that enjoys a specific tax regime, a reduced tax rate, you still look at the country level. So it doesn't mean that on the country level you necessarily will be below the 15 or whatever the threshold, okay, will be applicable in that particular case. So that's, I think, good news number one. Good news number two, I think specifically talking about Israel, is that at least we can definitely say in confidence now that eventually the ITA, the Israel Tax Authority, does understand that there is a challenge, which I think it's a big move forward. So I don't know yet what they're going to, decide, but they understand that it's an issue that must be addressed. And I think hopefully, most of the countries will do the same. Okay, so we'll see, what kind of, alternatives they will suggest eventually. There's some thoughts already, maybe something will maybe related to other taxes, some like kind of social security, we'll see. There are more good news actually to share. Another good news is that, as Rui mentioned during the presentation, there are certain exclusions. So it depends what business you are in. Let's say if your business is labor intense, you get an exclusion on your salary, the salaries that you pay to people, and at least 5% will be added on that. Okay, so that's something that get excluded from the calculation. Plus, if you have a capital intense manufacturing, like you have a lot, capital intense business, big investments, so you're getting an additional 5% exclusion on your tangible assets. So there are a couple of good news. So it's not everything is so bad, but clearly, that's going to be additional burden without a doubt. Going to be additional burden on the calculation, and clearly, the filing issue will be also a certain burden on that. But still, it's not kind of everything is kind of black. We do have gray areas, but we also have some white areas. So so that's okay.
Really, if I can just add on to what you said, I think everything you said was 100%. What we're also seeing is this is not a challenge just for Israel. This is a challenge for all countries. They are looking at how to incentivize. We're looking at grants across the world. We're looking at non-tax related incentivization schemes. And I think that the key message to take away from here is, particularly and specifically for Israel, is don't change your strategy as a result of this. Keep with the path until we know more data from the tax authority. The tax authority is not looking to remove Chokidud or change Chokidud in its entirety. For example, the QDMTT may reduce slightly the benefit of the Chokidud for some companies, but not for all companies. So stick to the path until such a point that path is therefore removed. We don't believe that will ever be the case because it's not in the scope from the tax authority's perspective. But speak to your advisors, speak to your teams, because there are other ways that this can be achieved.
Okay, thank you, Rui. One more question. To consolidate, calculate the average, the parent company needs to be in the same country as the subs. What if we have a few, I guess it's LE, local entities, I guess, or report to the ES parent? Well, I guess report is less relevant probably. Here it's it's more about the owned by, right? It's a consolidation question. And Rui, would you like to add, or you want me to answer?
Sure. So I think, again, it's just to recall in this situation, when we talk about the scope, it's looking at multinationals. So it's as long as you're in more than one country, so you have your UP in one country, and even just as we said, a branch in another country, that's enough to fall within the rules. When we're looking then at consolidation, that will ultimately be your accounting policies that come into play. And by the way, thinking about the accounting policies and the accounting rules that are done is ever more important, because these rules are primarily based on accounting policy. So in the situation whereby you have a few entities in different countries all reporting back to a US parent, as we said before, then you would still have to look at the consolidation from a scoping perspective, But then, as we said, the effective tax rate calculation, the tax calculation, is done on a country-by-country basis. And it also means that the reporting is done country by country. So there is a filing requirement. Even if it is only one country in the entire group is within the scope of the rules, then there is a reporting requirement. Now, we are here to help. You know, we've said that is our purpose here. We're helping not just on this, but in terms of even with the authorities, we're having close conversations with them. But it's a matter of understanding the reporting requirement and understanding how the calculation is done.
Thank you for that, Roy. Another question is about, like, are there any industries excluded from the Pillar 2? I think I can understand where the question comes from, because, you know, there was a lot of discussion around, you know, Pillar 1, because, you know, what industries, and Pillar 1 is still a big discussion, but seems like some industries, you know, dealing with commodities, you know, mining companies may be clearly excluded from Pillar 1 that deal mostly with digital economy. But I guess the answer for, I know there are some lobbies that we were trying to, and we saw it, like there was also a lobby, I know, like for example, you know, airline companies, they're trying to get, you know, an exclusion from the CBC requirements. But I'm afraid that just similar to the CBC requirements, we do not expect any industry to be excluded from the requirements, so that's probably gonna, you know, apply across the board. I think another thing probably to remember is that, I mean, clearly as a group, all the reporting requirements, you know, are applicable only to those with the consolidated revenue of 750 million euro. You know, for as we mentioned, like a bit different from the CBC, you need to look at, you know, 2 out of 4 years preceding the reporting year. But you know, for CBC it's a bit different, just looking at 1 year. But what is important here is that even if you're still not there, I mean, you're still below 750, it still may impact you, because as you will see, many countries will just introduce different tax rate, will change their, you know, like kind of, you know, incentives, and, you know, their tax regimes, their IP boxes. So I can't really, I'm hard to believe to them, you know, that they will just do, you know, certain changes just for like M&As with 750 and above, because that may be viewed as a discrimination. So, I mean, again, clearly the reporting requirements, all the calculation is only for those relatively big groups with 750 and above. But still, you know, you have to stay tuned, even if you're not there yet, have to stay tuned, because, you know, there may be many changes in the law that will impact your business, even if you are not, you know, kind of, you know, qualify, you're still not over the 750 million euro threshold, or it can be any kind of local, you know, local currency equivalent, just as it was, you know, implemented for the CBC reporting. Okay, let's see. Are the US ever going to join Pillar 2? Okay, that's a tricky question. I'm not sure I want to answer that. But yeah, it's I don't know. You feel free to add. I think it's like it's very political. It's I think from the beginning of the discussions, I think the US. I mean, for those of you who are relatively familiar with the, you know, tax environment in the US and may be aware of the so-called, you know, Trump tax reform, there were like quite a few kind of new taxes introduced in the US, such as GILTI, you know, such as FDII, such as BEAT. So I think, and CFC rules that were there kind of forever. So I think, you know, the general, I would say that the perception of the IRS and the US government in general, and I don't think that has anything to do with like with a particular party, just in general, I think they frankly believe that their system is good enough to address most of the issues. So, you know, my personal take, and it's not that I spoke to anyone from the US Treasury or something, but my personal belief is that I think it's most likely that what they're going to do, they're going to introduce some changes to the requirement. Definitely GILTI, for example, for those for you who know. So GILTI, for example, provides today an exclusion only for tangible assets, but 10% on tangible assets. It does not provide an exclusion 5%, let's say, on the salaries, okay? So I think that they will adjust that just to be in line, but, you know, I'm not sure if they're going to implement, you know, like the entire scope as it is, but, you know, we'll see. I mean, Roy, if you have a different view.
From the US's perspective, so obviously that the right now the OECD have allowed that the guilty is to be treated as a qualified CFC. So there's no risk at the moment, at least on a temporary basis, of double taxation as a result of something like guilty. But yeah, I think that the principle is, and we've seen it from the US, they did try to do it originally, was to amend guilty to make it qualified IIR, and therefore fall within the rules. The rules will apply. The ultimate premise is that the US will apply. We believe that the US will apply Pillar 2 in the future. They will apply it. It has to be done as an all or nothing, so therefore it will apply in full. But then again, like all countries, the US will look at other ways to incentivize business and grow as a result of these. But to not do anything and to kind of keep status quo is just a lost position for the US.
Okay, one more question here. Yeah.
I think we should wrap it up.
Let's take one last question then, can we?
Okay.
Okay, so the quick question: if I'm in the rules once, does it mean it is relevant forever? So the answer is no. As you said, I think as Roy said, that you need to look at what your revenue is. So if your revenue, the consolidated group, goes down for any reason, or let's say you sell part of the business, you go for restructuring, so you may just easily get out of that if you just get, you know, below the threshold of 750 for 2 years out of 4. Yeah. No, please.
Okay. תודה רבה לכל המשתתפים והמשתתפות, תודה שהצטרפתם אלינו, תודה לווילי, תודה לרועי ולסגי. הוובינר הבא שלנו כבר הוא יהיה ב9/8, אתם מוזמנים להצטרף. היום דיברנו על הבעיה, שלב הבא יהיה לדבר על הפתרונות. וכמובן שכל שאלה שעולה לכם אתם מוזמנים להתייעץ, אנחנו נשלח סיכום לכל המשתתפים עם פרטי הקשר שלנו. תודה רבה ולהתראות.